Hormuz is open. Brent just erased every gain from the war. $66 gone in 4 months. The market has declared the crisis over. Here's what the market hasn't priced yet. The deal that opened Hormuz lasts 60 days. The harder talks, Iran's nuclear program, Lebanon, reparations haven't started. US oil stocks just hit their lowest since 1984. And Iran's navy still says every ship crossing the strait needs its permission. Hormuz is open for business. The question is, for how long? Welcome to Crude Oil Desk. Every week we track where oil is flowing, what it costs, and what it means. This is Issue 9. Hormuz reopened June 17th. 31 vessels crossed in a single day by June 24th. Brent fell below its pre-war close. Goldman Sachs called the physical market oversupplied. The consensus, crisis resolved. Today we explain what the consensus is missing and why the 60-day clock matters more than the price. Here is what happened the week after the MOU was signed. Middle East crude exports had been at 7,888,000 barrels a day in May, a 60% cut from pre-war. When Hormuz opened, the trapped barrels flooded out. Saudi tanker giant Bahri, which hadn't crossed the strait once during the war, started moving. Iran shipped 30 million barrels to Asia under the sanctions waiver. The UAE sold 60 million barrels in tender deals. On June 24th, the US Energy Secretary said 20 million barrels exited in a single 24-hour window. The effects showed up immediately. Brent's prompt spread flipped into contango. Spot barrels now trade cheaper than futures, the technical signature of an oversupplied market. Angola is selling at its biggest discount in a decade. Chinese refiners are offering cargoes for resale. Asian buyers are covered through August. The flush is real, but it is a one-time release, not a structural recovery. The COD supply-demand balances show where this goes. March, a deficit of 3,748,000 barrels a day. By July, that flips into surplus. By September, the surplus reaches 4,479,000 barrels a day, an 8,000 barrel swing in 6 months. Macquarie forecasts 67 Brent for the third quarter. The IEA projects a significant surplus in 2027. These are now the base case, not the fringe. Goldman Sachs put it plainly. You actually get a discount to buy a barrel now versus tomorrow because of the weakness in Asian demand for Middle Eastern grades. Reopening is going well and quickly. That is the bull case. Now, the fine print. The MOU runs 60 days. It covers transit rights through Hormuz and a temporary US sanctions waiver on Iranian oil. That is all it covers. Iran's nuclear program, not covered. Lebanon, not covered. Reparations for the war, not covered. Those 3 issues are harder than anything already agreed. And none of the talks have started. The reopening itself is not complete. Vessels are avoiding the main channel, hugging the Iranian coast or taking the Oman southern route with military escorts. Demining takes weeks. Iran's Revolutionary Guard Navy has said coordination with its forces remains mandatory for every transiting vessel, not an internationally recognized rite of passage. A daily reminder of who controls the choke point. Trump has called Hormuz tolls a red line. Iran has not dropped the idea. The clock started June 17th. Mid-August is the deadline. While the market is focused on the oversupply signal from the Hormuz flush, there is a tightness signal in the United States that most coverage is missing. US crude inventories are at their lowest since 1984. Cushing, Oklahoma, the WTI delivery point and reference for US pipeline infrastructure, sits at 19 million barrels, the operational minimum, the level below which pipelines and refineries cannot function normally, is 25 million. Cushing is below the floor. A senior analyst at an independent consultancy told Reuters, "We have burned through so much inventory and we are at extremely precarious levels. But the market has completely traded through that. The market is right that it cannot last. But getting back above the operational minimum requires weeks of inventory builds. Until then, US export capacity remains physically constrained, and the one remaining tightness signal in the global system is American. Here is the distinction: the market is not pricing fully. The flush of trapped barrels is causing the short-term oversupply. It reflects 60 to 100 million barrels that built up behind the Hormuz blockade and is now hitting the market at once. That is different from production restarting. Oil fields shut in during the war do not snap back immediately. Reservoir pressure management, crew rotations, maintenance backlogs. Full restart typically takes 6 to 8 weeks. The real supply picture will only be clear in October. If the talks stall and the wave elapses, Iranian exports stop overnight. The flush ends. The rebuild does not. The numbers to hold on to: Brent pre-war close, 72.48. Peak, April 7th, 138. June 25th, 72.40. A $66 round trip in 4 months. Meg exports at the May trough, 7,888,000 barrels a day, down 60% from pre-war. June 21st to 25th, 14,000, the highest 5-day run since March. US inventories, lowest since 1984. Cushing, 19 million barrels, below the 25 million operational minimum. MOU window, 60 days from June 17th. Macquarie Q3, Brent forecast, 67. Independent consultancy structural floor, once the flush ends, 80 to 90. 5 signals to watch. 1. The 60-day clock. The MOU expires mid-August. Nuclear talks haven't started. If they stall, the sanctions wave elapses and Iranian exports stop overnight. Watch for any joint statement or breakdown signal before the August deadline. 2. Cushing recovery. Watch EIA Wednesday data. Any week above 25 million barrels restores full US export capacity and removes the last tightness signal in the market. 3. Inventory rebuild pace. The surplus forecast assumes US, European and Asian stocks rebuild from multi-decade lows. Watch EIA weekly draws. If they continue despite the Hormuz opening, the balance model breaks. 4. Iran post-waiver exports. Watch vessel tracking in late July and early August. A build toward 1.5 million barrels a day means the market is pricing in a deal. A stall means it is not. 5. Brent at 70, floor or trap. Watch physical market discounts. If Angola and Middle East spot discounts narrow by mid-July, the structural floor argument wins. If they widen, 67 is achievable. That is issue 9 of Crude Oil Desk. The market may be right, but it is pricing a 60-day ceasefire as a permanent settlement. And those are not the same thing. Subscribe, free, no noise. Link in the description. We will be watching that August deadline closely.